Hello, good morning, good afternoon, and welcome to this session on Basel implementation, part of the Driving Resiliency in Financial Services. I'm John Foulet. I look after financial services analytics, solution consulting for Oracle, for Middle East, Africa, and Asia Pacific. I'm based in Singapore and I've been working in Oracle for more than 10 years. Prior to joining Oracle, I've worked in many technology providers, but I've also worked in banks and been involved in implementation of Basel across the world from the UK all the way to New Zealand. As you all know, Basel is not a single regulation, but is an evolving animal that has taken us from the replacement to the Cook ratio, which was a fairly high level and simple assessment of the capital required in order to facilitate and serve as a cushion to guarantee deposits, to something very comprehensive now that covers a huge number of risks. From Basel I, we evolved into Basel II, having a fairly comprehensive assessment of both market and credit risk, and starting both on the process and on the calculation side to look at operational risk. Basel III, on the back of the global financial crisis, gave us some additional requirement related to liquidity risk and counterparty credit risk. BCBS 239 gave us the risk data aggregation and reporting guidelines, which gave us a framework to look at the data. Can we easily consolidate exposure? Can we easily provide the board and the board members access to the information which is relevant with the right level of data in a timely manner, in a granular manner, in a reconciled manner? And today we are looking at Basel III post-crisis reform, which includes regulatory reporting, which includes additional changes to countercyclical capital buffer, and a raft of evolution of these requirements. So these rules change, they change over time, and it's always very important to consider this when you look at technology, because that technology needs to be able to accommodate future change. So the platform and the way you're going to consider these is going to be critical in your success in this initiative. Internally, there are many stakeholders to these Basel initiatives. There's obviously the Chief Risk Officer, but the Chief Risk Officer also needs to work with the Chief Financial Officer, because many of these elements that are calculated as a result of Basel are also going to inform processes such as capital planning and balance sheet planning, decision on pricing, decision on where we're going to allocate capital across business line and product. So within an organization, we need to manage multiple stakeholders, and that's one of the challenges. Now, that's not all, because besides stakeholders, we also have to manage multiple regulators. So if I'm a bank based in Singapore, of course, I will need to comply with the rules set by MAS, but I will also need to comply with the rules set by the supervisor and regulatory body in each other country where I do have a subsidiary or entity or a bank. That could mean HKMA, that could mean APRA in Australia, that could mean RBI in India, which makes it very complicated from an organization perspective, multiple internal stakeholders and multiple external stakeholders. So the typical challenges that we face in this Basel initiative is that we have so many disparate systems. We would have multiple core banking systems, multiple digital channels, multiple sources of data. That means that the data is in disparate systems. I have multiple environments. There are a lot of transformations that are done, typically through spreadsheets. And this leads to a huge problem in terms of data quality, data consistency, traceability, and governance. Now, part of Pillar 2 sets the way the regulator look at the reports and look at the numbers and the calculation that the bank operates. And here's the biggest challenge today. It's no longer about the calculation of an RWA number or a capital requirement. It is really about how we derived and arrived at that final number. And this brings us back to these data sourcing issues. So very often the dialogue that happens between the bank and the supervisor is not so much how accurate the number is, but how did you derive that number? So the how becomes a lot more important than the number itself. And because of all these manual processes, we have issues of error, of timing, of controls that we need to put in place before we can provide these reporting requirements. So very time consuming, very costly, lots of duplication of work. Typically, the reconciliation process happens at multi-point in the process. And also the way banks have typically approached this was aligned with the regulatory guideline at the time. So many banks actually implemented market risk engines, for example, during the first wave of Basel, say around 1994, and then moved and invested in credit risk with the implementation of Basel II around 2006, and are now looking at liquidity risk and other applications. And the challenge is that in many of these instances, the regulator is not interested in as to when you actually purchased and procure the technology, but how are you going to submit one single report despite the fact that you have multiple engines in order to aggregate the data from. One of my customers actually shared that from a risk technology perspective, the number of systems that was involved in that tier one bank in Australia for the redaction of the regulatory report was 87 different types of systems. So you can imagine the cost and impact and difficulty in bringing together the data that comes from 87 different systems. Some systems will be very specialized, for example, assessing the credit risk for securitization. Some of them will be very close to credit scoring and credit modeling, for example, PD for retail portfolio. But all these systems actually calculate a piece of the puzzle that is of importance when producing these reports. So bringing this data together and making sure that it's reconciled, it's timely, it is accurate data is a huge challenge. So what are the bank's goals? Typically, banks are looking at reducing the cost by automating, leveraging the data that has already been sourced, automating the calculations, ensuring that the submissions are timely and accurate, enhancing the data for governance and traceability, and also leveraging these output for decision making. So today, a lot of regulations are actually driving the risk and the finance initiatives together, much closer together. For example, IFRS 9 leverages the probability of default model, which up until now was very much in the sphere of credit risk, to define what are the appropriate level of provisioning for an expected loan, expected credit loss. And this drives the ability to utilize the infrastructure that we have in place for decision making. This could be provisioning in the context of IFRS 9. This could be related to pricing in the context of risk adjustment performance management. This could be related to balance sheet management and how each of these numbers can be used in order to make some decision as to how we're going to be managing the bank, what lines of product we need to invest in, what segment is most profitable, etc., etc. So here's the opportunity to change. We have numerous regulatory requirements. These changes are frequent. We have very tight deadline, a lot tighter deadline than we ever had. We have ever increasing data requirements. And on this front, it's actually quite interesting that many regulators are moving away from the typical format to getting access directly to the underlying data. So it is very possible that 10 years from now, there will be no such thing as regulatory reporting, but you will have data sets that the regulator will be able to access in your bank in order to be able to derive all the intelligence and all the analytics that is required for them. And obviously, there's a reputational risk to not being able to ascertain or define and address these requirements. But there's obviously opportunities in terms of liquidity management, opportunity in terms of capital optimizations. So there are opportunities for change, some driven by the regulator, some driven by our ability to leverage these changes for our own benefits. So it's always a matter of balancing act. We have to obviously look at the compliance aspects. We need to calculate regulatory capital. We need to calculate liquidity ratio, LCR and SFR. We need to calculate conservancy buffer. We have to calculate leverage ratio. That's all related to the minimum that we have to do. That's the flight to safety. But we also can use these elements in order to define our return on equity, to define our profitability and net interest margin, to assess and manage our default risk. So taking a strategic approach doesn't mean just complying with regulation, but it's about leveraging the effort that we need to invest in order to comply to the benefits of the organization. To that effect, OFSAA, as our own capital adequacy solution, which provides the complete end-to-end capability. And it starts from a data foundation, which means that data is sourced with a predefined and pre-built data quality checks. For example, the IRB prescribed that data probability of default would actually meet a PD floor of 0.03%. You will have prepackaged data quality rules that will actually allow you to ensure that even if probability of default at an account or customer level was to be provided below 0.03, that number is actually replaced by the floor. The data foundation allows us to provide an end-to-end view of the data governance. We then have the Basel engine, calculating all the different aspects, pre-mitigation, post-mitigations, doing the allocation of collateral in an optimized manner, the capital conservancy, both for securitized and non-securitized exposure. Regulatory reporting, everything related to ICAAP, so Pillar 2 disclosure and Pillar 3 disclosure, providing you with the information, if need be, at a granular level. All the capabilities that we provide in the platform are always at the most granular level. Why? Because this allows you to completely reconcile the final RWA or capital number that you calculate down to the individual loan or transaction. This also allows you to calculate, for example, a profitability or return on investment or return on line of business or product, because we have calculated the capital number at the most granular level, at the level of the individual transaction. All this feeds into the approach, which is the unification of risk and finance by having a single platform, which is not only a single data model, but also a single calculation engine, a single modeling engine, which allows us to have, for example, artificial intelligence in the context of prepayment modeling, artificial intelligence and machine learning in the context of credit modeling, and a single environment for all the reporting needs. It does not matter whether you are using multiple engines in order to calculate liquidity risk, market risk, credit risk, but you can consolidate all these data elements into a single platform. So from a typical status quo, you are able to build a single source of truth across risk and finance through a single data model. We standardize all of this process, which means that it's reusable. The data that is sourced for the purpose of Basel can be used for asset liability management, can be used for profitability, can be used for FTP, can be used for economic capital. The complete end-to-end data governance framework is in full compliance with BCBS 239. It allows you to phase your investment not in a big bang approach, but sequentially and incrementally. Because there is only one single source of data, every single stream of work that you accomplish will help you achieve compliance with the next scheme of work. So for example, if you start with Basel, and 60% of the data is actually shared between Basel and asset liability management, that's 60% of the work for your asset liability management project that is already done. And therefore, leveraging the existing infrastructure is actually going to be very important. What we're creating is data as a strategic asset. One of my customers actually described the FTP data that is implemented as the cleanest source of balance sheet data that they have in the entire organization. And here's the beauty. Once reconciled, once clean, that data can be used multiple times for an incredibly large number of use cases, spanning financial crime, spanning performance management, risk management, and customer insight. And finally, as Oracle is a technology vendor, the infrastructure and the technology always keep up with the developments in technology. Clouds, multiple options are provided in terms of deployment, providing you the best of not only risk vendor, but also technology vendors. Today, there are more than 500 customers that are using the OffSAR product range, and 24 out of the 28 global CFIs are using Oracle Financial Services analytical applications for the purpose of Basel. Thank you very much for listening to this session. I hope you did find it interesting. I would encourage you to join me and reach out to me if you have any questions, and we will be more than happy to help you in that process.